Welcome back to Investing Talk Podcast.
Today we're looking at Circle Internet Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm and lets us know what you want to hear more of.
And honestly, if you have any exposure to the financial sector or even just tech in general, you are going to want to pay really close attention to this breakdown. Circle Internet Group just dropped their fourth quarter earnings for 2025, and the numbers are, well, they are aggressive.
Aggressive is definitely a polite way to put it. I mean, I've seen the headlines out there screaming about crushed estimates, but let's hit the pause button for a second. We really need to frame this properly before we jump in.
Right. Context is everything here.
Exactly. Because whenever I see a company that lives in that crypto-adjacent neighborhood posting these massive numbers, my skepticism radar just starts pinging like crazy. We have seen this exact movie before.
The classic boom and bust.
Right. A massive hype cycle, a huge surge in volume just because Bitcoin went up, and then a total crash when the excitement fades. So my question, and really the core mission for our analysis today, is simple. Is Circle's performance just a sugar high from a crypto bull run? Or is there actually a sustainable business model underneath it all?
That is the perfect way to frame it. And look, I totally get the skepticism. Usually when these crypto-linked stocks fly, it's purely speculative. But if you actually dig into the raw data, going line by line through the actual financials, this doesn't look like a speculative pop.
Really?
Yeah, the data is strongly suggesting a fundamental shift in utility.
Yeah.
We aren't just seeing people trading crypto chips at a casino anymore. We are seeing a massive increase in the actual plumbing of the global financial system.
Okay, plumbing isn't exactly a sexy word, but in investing, boring plumbing is usually where the real money is made.
Exactly.
Let's strip away the narrative for a moment then and look at the cold hard cash. You said they crushed it. Give me the headline numbers. What is the revenue actually looking like?
It is a total blowout. For the fourth quarter of 2025 alone, Circle reported revenue and reserve income of $770 million.
Okay, stop right there. Reserve income. For the listener who might not be a CPA or deep in the weeds of fintech, let's just clarify that term quickly.
Yeah.
Circle issues USDC, which is a stablecoin. You give them $1, they give you a digital token. They take your dollar and put it in safe stuff like, U.S. Treasuries. Reserve income is basically the interest they earn on that massive cash pile, right?
Exactly. It's the float. Think of them essentially as a bank that doesn't lend out risky loans to buy houses or cars. They just sit there and harvest the risk-free interest on government debt.
Not a bad gig.
Not at all. So that 770 million figure, that is up 77% year over year compared to the same quarter last year.
77% growth is, that is hefty, especially for a company that relies heavily on interest rates, which haven't exactly been skyrocketing lately.
It is huge. And to give you the Wall Street context, the consensus estimates what the smart money thought would happen. We're sitting around 739 to 745 million. So Circle didn't just squeak by. They cleared the top end of expectations incredibly comfortably.
That's a very solid quarterly beat. But, one good quarter doesn't make a trend. We've seen plenty of companies have a lucky 3 months.
Yeah.
What about the full year of 2025? Did they keep that pace up, or was Q4 just some sort of anomaly?
No, it was sustained momentum throughout the entire year. For the full fiscal year 2025, revenue hit $2.47 billion. That is a 64% increase from 2024.
Wow.
But I really want to highlight the specific driver here, because this addresses your skepticism about those sugar highs. This wasn't just about interest rates staying elevated. In fact, their reserve return rates, the actual yield they get on that cash, declined by about 68 basis points.
Hold on, that's a crucial insight. If the interest rate they earn on the cash dropped, their revenue should theoretically go down, or at least just flatten out entirely. How on earth did they grow revenue 64% if they were earning less on every single dollar they held?
Volume. Pure, unadulterated volume. They saw 100% growth in the average circulation of USDC.
100%.
Yeah, they literally doubled the amount of digital dollars floating around the world in a single year. That insane volume growth completely overpowered the headwind from the lower interest rates.
Okay, so the pie got twice as big, meaning it didn't really matter that their specific slice got slightly thinner. That's a pure volume story.
Exactly. And that implies real adoption, not just speculation. It means more people are actually holding and using the currency in their day-to-day operations.
Fair point. That is undeniably impressive growth. But let's move to the bottom line. Revenue is vanity, profit is sanity, as the old saying goes. I
Mhm.
saw the EPS numbers, the earnings per share, and honestly, they looked a bit erratic to me at first glance. Walk us through that.
This is where the crushed headline really comes from. For Q4, they reported a diluted EPS of 43 cents. The estimate from analysts was just 35 cents. That's a 23% beat right there. But the basic EPS, that came in at 56 cents versus a consensus of just 17 cents.
Wait, pause again. 56 cents versus 17 cents. That is a 233% beat.
It is massive.
Why is there such a massive gap between the basic EPS and the diluted EPS, though? Because honestly, that feels a little bit like a trap to me.
It's not a trap, but it is a very important distinction to make. Diluted EPS accounts for all the stock options, the warrants, and convertible debt that could potentially be turned into shares down the line. It's the worst case scenario for share count.
The more conservative number.
Right, exactly. But even taking that conservative number, they beat by 23%. The basic EPS blowout just shows how much raw cash the core business is generating before you account for the potential share dilution from things like employee stock options.
Okay, so they are highly profitable on a per-share basis for the quarter. But, and you knew I was going to bring this up because I always look at the full year data. Despite $2.7 billion in revenue, despite doubling circulation, they reported a full year net loss of $70 million.
I knew you'd catch that.
I mean, come on. How does a company print that much money, act like a bank with literally zero risky loans, and still end up $70 million in the hole? To me, that screams broken business model. Are they just spending $2 to make $1 here?
It's a totally fair question, and honestly, it's the main bearish argument out there right now, but you really have to peel back the layers of the onion on this one. That $70 million loss wasn't an operational failure at all. It was an accounting event.
An accounting event.
Yeah, it was primarily driven by one-time costs associated with their IPO. Specifically, they booked $424 million in stock-based compensation related to going public.
Okay, let's break down stock-based compensation for a second. This is paying employees in shares instead of cash out of the bank, right?
Correct. When they went public, a lot of those employee stock options vested, meaning the team could finally claim them. Under the accounting rules, the company has to record that value as a massive expense on the income statement for that year, even though no actual cash left the company's bank account. It's entirely a paper expense.
I'll push back slightly on that. It's the paper expense, sure, but it dilutes the shareholders, so it's a very real cost to us as investors.
Yeah.
But I do get your point regarding the underlying business health. It doesn't drain their bank account or threaten their actual solvency.
Exactly.
So if we completely ignore that one-time accounting hit, what does the core business actually look like?
If you look at adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, basically the standard proxy for operational cash flow, the picture flips completely. In Q4 alone, adjusted EBITDA surged 412% to $167 million.
412% growth. That's absurd.
Yes. And for the full year, it doubled to $582 million. So operationally speaking, the machine is printing cash. The loss you saw is largely just the accounting cost of listing on the stock exchange and rewarding the early team that got them there.
Okay, that makes a very significant difference.
Right.
If the operational cash flow is over $500 million, I am way less worried about the paper loss. Let's talk about efficiency then. Usually when tech companies grow this aggressively, doubling their user base or circulation, their costs absolutely explode because they are hiring like crazy and just burning marketing spend. What are the margins telling us?
This is actually one of the strongest parts of the entire report. They use a metric called RLDC margin.
RLDC. We have a lot of acronyms today. Let's decode that one.
Right. It stands for realized liquidity and digital circulation. Essentially, just think of it as their gross margin on the stablecoin business itself. That margin expanded to 40% in Q4. That is up over 1,000 basis points year over year.
1,000 basis points is just a fancy Wall Street way of saying 10%. So they improve their profit margins by a full 10% while simultaneously doubling the size of the business.
Yes.
That suggests they have incredible operating leverage. It doesn't really cost them much more to manage 100 billion than it does to manage 50 billion.
Precisely. Because it's software. Once the core infrastructure is built, the marginal cost of the very next dollar coming into the system is near zero. And their forward guidance suggests they believe this is the new normal. For fiscal year 2026, they are targeting those margins to remain firmly between 38 and 40%.
That's strong.
Plus, and this is the real kicker here, they're projecting a multi-year compound annual growth rate, a CAGR, of 40% for USDC circulation.
That is a very bold claim. They expect to keep growing the total user base at 40% a year while maintaining 40% margins. That is pretty much the textbook definition of a high-growth compounder.
It really is.
But that leads me to the big why. Why are they able to do this? What is actually protecting them from competition? Because last I checked, Tether is still the absolute big dog in the yard, and you have massive players like PayPal entering the space, plus traditional banks talking about their own coins. Why Circle?
It basically comes down to the network effect, but with a very specific twist. Yes, USDC is the second largest stablecoin with about 75.3 billion in circulation, but their main differentiator isn't just their size, it's trust.
Trust in crypto, that's usually an oxymoron.
Usually, yes. But unlike some competitors, let's just say Tether has had its fair share of controversy regarding what actually backs their token circle, has leaned incredibly heavily into regulation and transparency right from day one. They publish monthly attestations. They clearly want to be seen as the adult in the room.
So they're playing the compliance card heavily.
Exactly. And for institutional users, we're talking major tier 1 banks, huge payment processors like Visa, DeFi protocols that actually want to stay legal. That compliance layer creates incredibly high switching costs. If you are a major bank, you aren't going to risk using an unregulated stablecoin just to save a fraction of a penny. You use the one that the regulators aren't actively trying to shut down. It's just safer.
So Circle is basically the clean shirt in the dirty laundry pile of the crypto industry.
That's a great way to put it, yeah. And they aren't just a one-trick pony with the US dollar anymore either. They are diversifying. Their euro-backed coin, URC, is up 284%, and their yield-bearing coin, USYC, is up 111%.
Wait, yield-bearing, so USYC actually pays the holder interest directly?
Yes, for qualified investors. So they are building a full suite of regulated financial tools, not just a single token. They're essentially building a brand new kind of commercial bank natively on the blockchain.
That is a fascinating pivot. It's almost like they're becoming a neobank for institutions. Okay, so the fundamentals are screaming growth and efficiency. But the market is a voting machine in the short term. Let's pivot to the charts and see how investors are actually reacting to this news. Was this a sell the news event?
Far from it. If the fundamentals were a scream, the price action was an absolute roar. On February 25th, 2026, right after the report dropped, shares surged 16 to 18% in the pre-market.
18% is a massive move for a company of this sheer size.
It was a classic technical breakout. The stock had some major overhead resistance levels, price points where sellers usually step in. And this earnings report provided the exact catalyst needed to just blow right through them.
And was there real weight behind the punch? I always hate seeing price spikes on low volume. It usually means it's a fake out and the price will just come right back down the next day.
The volume was definitely there. Leading up to the release, we saw some very unusual options activity.
Unusual options activity. My absolute favorite euphemism for someone knew something.
Or at the very least, someone was betting big with very high conviction. We saw a gap up of 16% right at the open. Now, retail investors, the everyday folks trading on their phones, they usually don't move a stock 16% at the opening bell. That requires deep pockets. That is big money stepping in.
Institutional money.
Exactly. And looking at the broader liquidity, the trailing 30-day annualized transaction volume on their network reached $5.7 billion as of February 20th. That shows that the underlying network is seeing massive throughput, which completely supports the stock price action. It's not just hype. The network is genuinely busy.
So the charts look great, the numbers look great. Moving on to what the street is thinking. What is the overall vibe out there? You mentioned the unusual options, but are the mainstream analysts buying this story, or are they still cautious?
The mood right now can be characterized as overwhelmingly bullish.
I imagine it's pretty hard to be bearish when a company beats basic earnings per share by over 200%.
It is very hard to argue with that kind of beat. The financial headlines are completely dominated by words like skyrocketing and crushing estimates. The top stories are all focused squarely on that EPS beat and the huge revenue surge.
And you mentioned institutional interest earlier. Are we seeing the whales really coming in here?
We are. There has been a very clear trend of whale activity and institutional accumulation in IT and fintech stocks generally over the last few weeks, and Circle has been a major beneficiary of that flow. It seems like the big funds were positioning themselves specifically for this beat. They want exposure to the crypto infrastructure without having to buy Bitcoin directly.
That makes perfect sense. Circle is the classic pick and shovel play. You don't bet on the gold, you bet on the guy selling the shovels. What about the rumor mill, though? Is there anything speculative floating around that might drive the stock further in 2026, beyond just issuing more USDC?
There are definitely some whispers out there. Analysts are looking closely at the potential for scaling the Circle payments network. There's also a lot of talk about new banking partnerships that could act as massive catalysts for a further rebound in 2026. If they can embed themselves deeper into the traditional banking system, think of it like Swift, but much faster, that opens up a whole new level of global volume.
Right, bridging the gap between crypto and traditional finance. That is the holy grail. But I'm the skeptic here, and it is my job to rain on the parade a little bit. We have painted a very rosy picture so far. Now let's look at the risks. Because no stock goes up in a straight line forever. What could actually go wrong here?
That is totally fair. What are you most worried about?
Well, the obvious one is crypto volatility. We can call it a financial infrastructure company all we want, but at the end of the day, it's still a stablecoin issuer. On February 23rd, literally just a couple of days before these earnings, Bitcoin dropped below $65,000. And looking at the chart, Circle stock felt that downward pressure almost immediately.
That is true. They are definitely still correlated to the broader market.
So isn't there a massive risk that if the crypto market enters a prolonged winter, say Bitcoin goes back down to 30,000, Circle gets dragged down with it, regardless of how good their fundamentals are? If people stop trading crypto, they stop using USDC, right?
It is a very valid concern, and historically speaking, that correlation has been incredibly high. But here is the main counterargument that the bulls are making right now. Decoupling.
Decoupling. Explain that.
It means the stock price naturally stops moving in lockstep with Bitcoin. Look at the on-chain transaction volume we talked about. It grew 247%. That tells us that people are using USDC for actual payments, for real-world settlement, for sending money cross-border. They aren't just holding it hoping it goes up in value. Because it's a stablecoin, it literally can't go up in value.
Right. A dollar is a dollar. If you hold it, you aren't doing it to get rich.
Yeah, exactly. So if you are using it to pay a supplier in Singapore, you really don't care what the price of Bitcoin is doing that day. The usage is decoupling from the raw price action of speculative assets. It's becoming everyday payment rails, not just casino chips. The more it becomes a payment rail, the less Bitcoin's price actually matters to Circle's bottom line.
Okay, I see that distinction. If it becomes a genuine currency for global trade, the price of Bitcoin matters a lot less. But what about the operational costs? We talked about the net loss earlier. Even ignoring the stock-based comp, their operating expenses are rising fast. They hit $1.18 billion in OPEX. That is a ton of money.
Yeah.
Are they burning too much cash just to chase this top-line growth?
It is a significant spend, there is no doubt about it. $1.18 billion is hefty. But you have to look at it in terms of ROI, return on investment. They are actively spending to build out that global infrastructure. They are hiring legal teams in Europe, establishing new partnerships in Asia. And remember, the forward guidance. They are projecting their margins to stay between 38 and 40%.
So they believe they can maintain that high profitability even with the increased global spending.
Exactly. If you can spend $1 to reliably make $1.40, which is essentially what a 40% margin implies, you keep spending that dollar all day long. And the 412% growth in adjusted EBITDA totally backs that up. They aren't just burning cash to keep the lights on, they are reinvesting cash to capture the entire market.
So if you believe their margin guidance, the spending is completely justified. It's confident spending, not desperate spending.
Precisely.
All right, we've covered a lot of ground here today. We've seen the massive revenue beat, the explosion in USDC circulation, which somehow defied the drop in interest rates, the paper loss versus the massive cash flow reality, and the huge breakout in the stock price. It is time for the final verdict.
Based on everything we have reviewed today, the 77% revenue growth, the totally dominant market position, and the very clear path to future profitability, I am giving Circle Internet Group a bullish score of 9 out of 10.
A 9 out of 10. That is one of the highest scores we've given recently. Just to be absolutely clear for the listener, what is the core thesis here?
The thesis is that this is a multi-year hold play. This isn't just a quick trade for the next quarter. The entire argument rests on that 72% circulation growth metric and the steadfast 40% margin guidance. Circle is successfully transitioning from being viewed as just a volatile crypto play to becoming a foundational global financial infrastructure play. The 16% surge we saw post-earnings is really just the broader market finally waking up to this reality.
So you're basically saying we're watching the active construction of the next Visa or MasterCard, but built for the digital age.
In a way, yes. As they integrate more deeply with traditional banking and the payments network expands globally, the potential for compounding growth here is just massive.
Well, there you have it. The numbers don't lie, and right now the numbers are saying Circle is firing on absolutely all cylinders. But as always, do your own research. Just because the whales are buying doesn't mean you should jump in blindly.
Absolutely. Risk management is always key.
That's the data. Make sure to subscribe, like, and comment to help us beat the algorithm. See you in the next one.